So Anand, they can hear us, or how's it like?
Yeah, they can.
Okay.
Yes, we're live.
Okay.
For those that have joined, please give us a couple of more minutes. We're just waiting to make sure we get as many people who want to attend as possible. Okay, we are up to 120 people. So hello and welcome everybody to the SOF2, the State of the Fintech Union 2022 Neobanks panel. I am Avnish Bajaj of Matrix Partners. I've been with Matrix Partners since the beginning, and my job is to try to stay out of trouble. But on a more serious note, this kind of interaction and this quality of panel, especially given that fintech makes it to the news almost every day, is very exciting. Just a little bit of background on SOF2. So SOF2 is State of the Fintech Union. It's supposed to be an annual event, which we choose to do every couple of years. It really depends on what's happening in the environment. We are very grateful to our partners at BCG. So essentially, the objective of SOF2 is to help facilitate the entire ecosystem to take a step back and kind of take a state of the union and have an opportunity to discuss the issues that are topical and important. The methodology, like I said, our partners at BCG really help us. So we run and I'm going to introduce Neetu Chitkara, who's a partner at BCG. She's going to run this panel. She's the moderator. She'll maybe talk a little bit about the methodology, but the net of it is it's a survey of close to 200 people in the ecosystem, including regulators, including investors, founders. And then we they help us unpack the data, come up with insights, and at the end of it, we will have a report that we will share. We've had a wealth tech panel, we've had a payments panel, we've had a lending panel. I think this is the last panel, but my colleagues might correct me. So with that, Neetu, thank you again to you and BCG for partnering with us in this. And over to you to introduce the panelists and take it forward.
Sure. Thanks so much, Avnish. And yes, so I'm an MBA partner with the Mumbai office at BCG, work in the financial services space. And, fintech, of course, is, one of the big themes these days. So I think apart from the survey, which, Avnish mentioned, where we had inputs from almost 150, 200, participants, including fintechs, people from the banking industries, even some elements from regulations. We also had many one-on-one conversations, and I think it's been really interesting over the last few months understanding the pulse, of the industry. to talk more specifically on the neobanking panel. And Avnish, we do have 2 more coming. So we do have some really great panelists on the with us today. Let me do a quick introduction. So we have Anjani, who is the Chief Digital Officer at HDFC Bank. Anjani, of course, also brings in a lot of outside-in perspective. He was also the CIO at Airtel for almost 12 years. So thanks for Anjani to join us today. We have Anurag, who is the co-founder and CEO at Onecard, which also turned unicorn 6 days ago, Anurag. Yeah. So yeah, many congratulations on that. Anurag is also a banking veteran, was with ICICI Bank for more than 10 years before. So welcome, Anurag. And we have Jitendra, who's joining us from the US, and hence the timing of the panel today. Jitendra is actually a repeat entrepreneur. He is the co-founder and CEO at Jupiter, which is managed to get almost 1 million plus accounts in the last 9 months. But before that, he was also the founder at Citrus Pay. So we have a very interesting set of folks to talk about, both incumbent as well as neobanks, to talk about interesting both sides of the panel, as part of this discussion. But before we get started, what I thought is I can at least share some key perspectives, since we did the survey and we love to share data. Can you see my screen? Perfect. So what we want to cover, in the neobanking discussion, and these are some of the survey findings. But even before that, we at BCG have looked at the neobanking space in quite a bit of depth. And globally, what we see is there are about 250 odd, such neobank or digital challenger banks. Of that, about 50 of that are in the Asia Pacific. And what we have seen is, profitability, while valuations typically are quite high, profitability, of course, has been slightly more elusive in this front, where only 13 out of the 250 are actually profitable. Though, of course, that's beginning to change now, with many more kind of bringing towards the profitability milestone. And we'll talk about what are the elements which actually impact this profitability. If I look at India, which is what you see on this slide, of course, this has been a space with a lot of activity. So if you see both on the partnerships, which is on the left, there's been a number of partnerships happening in the neobanking space. In the last 12 months or so, you see 28% have partnered with 5+ partners, almost 40% with 2 to 5 partners. So a lot of action happening there. And also in the new launches. So whether it's deposits, cards, that's the, especially the liability side, seen a lot of, action in terms of launches. However, if you look at, what are the top issues on the minds of the industry, and this, starts to bring about the elements of profitability, because on one hand, cost of customer acquisition, of course, is on top of mind for many of the neobanks. And then also, once you do acquire a customer, how do you actually make money off them? So the entire ARPU angle. So both of these, twin areas, which we're going to talk about in detail, are obviously top of mind. I think the third interesting space is on regulations, and with what we've seen on PPI and at a broader level, I think that's something we are seeing in the entire fintech space. And with neobanking, one of the additional elements is we still don't have clear guidelines or framework, and that's obviously on top of mind of many participants. So therefore, regulations continues to be in the top 3. These are actually, when we ask people that do they feel there is actually clarity on the operating model of neobanks as well as their interaction with the banking license on the left, we do find that actually 83% feel that we don't have enough clarity. Right now we are making some assumptions and going forward, but it will be like many countries like Singapore actually do have separate digital banking licenses. So it is, and that's what you see on the right, that is there a need for digital banking license, or at the very least a bit of regulatory clarity around the framework in which digital banks operate, or digital only banks operate. In addition, I think even within the framework, there are thoughts with respect to what are the big hot issues on the minds of people, and we'll unpack this as we go forward as well. But for instance, how do you create, if you come up with a digital banking license, how do you create a level playing field? Because if you look at current licenses, there are the elements of branch footprint or PSL norms, and is there a room to create some of these as you think about, or rather do away with some of these as we look at the digital banking licenses. So that's, I would say, the sum and substance of what we heard so far. In terms of our discussion, we want to focus on 3 key areas. One, of course, is innovation and how we see that play out in the space. The second is just innovation is not sufficient, and particularly in the context of many of the points of funding winter and broader focus on sustainability, how do we see that pan out in the space? And then finally, the elements of regulation, because that's obviously almost the guardrails under which this space operates. So maybe let me stop sharing at this point, and we can actually delve into some of the discussions with the panelists. Let me start, maybe Anurag, with you. Given we want to talk about innovation and at a broader level. So we, of course, have seen, space after space in our own personal lives get disrupted, whether you look at shopping, you look at ride hailing, you look at ordering food. Do you think it's time for, banking to get disrupted as well? And, of course, you've started to get into that space, but your perspectives on that.
Yeah, thank you, Neetu, for having me here. It's pretty obvious because the consumer is exposed to digital experiences across categories. So why not banking? It's pretty obvious. And we've been watching it. Even if you look at, traditional banks, they have seen massive migration of customer interaction happening from branch-based physical channels to digital channels. Forget about fintechs, who probably came like last 5-6 years, in a significant way. But even within banking, the migration has happened. So consumer is already moving towards that. And it's all across, of course, customer segment, consumer side is much more visible, but even in SME side and corporate side, the migration is pretty much happening across the board. So I think this is a given task. Also got accelerated in over last 5-6 years, thanks to things like GST, Demon and COVID. But, disruption is a very strong word, especially when it is used in the context of banking. As I said that, especially for a country like ours, where the penetration of financial services is still quite low across the board. I'm like, whether it's banking, credit, insurance, investments, and this is pretty everything has been written around here. So I think right now, if you ask me, in short to medium term, I see more of expansion of the pie and disruption. And the other thing to note is that many people miss a lot of Indian banks in India. They are using tech built in India. So they actually keep updating quite often. So, if you compare Indian banking sector compared to lots of other banks, fairly, well developed, at least the backends are quite digitized. And last thing is, Indians still trust banks. Like lots of other Western geographies where, the trust factor is much reduced. And this is very important, for banking, because trust-based business. And we see, I keep giving examples to people that, like whatever you've been written about frauds and things like that, people still keep money in the bank. Not only banks, they keep jewelry in the banks. So that's the level of trust people have with that. So having said that, definitely 2 areas which I see personally, which is what driving digitization of banking, especially from a fintech perspective. One is expansion of the pie. There are segments where existing banks are not reaching, or probably their operating model doesn't make it suitable, economically viable for them to reach. That's one. And second thing is definitely on engagement oriented products, because what happens is that the front end businesses are so iterative in nature, and most of the banks still now at least have been buying techs. It's very difficult to iterate at that pace, and that's why those are the areas where we see, like, if I have to use your word, disruption is happening much more recent. And like you alluded to in your data as well, the deposits and savings and cards, and these are the 2 areas where it's very transaction intensive area, and hence engagement makes much more sense compared to, let's say, a pure play lending product. And the data sources have been just digitized over last 3-4 years. So it's right now going like a flux. So we see a lots of opportunity for fintechs to innovate on these layers, primarily where the customer facing layers, where things are more iterative in nature. If you control tech yourself, you build tech yourself, you can iterate faster. So it's given. I'll give you end my answer with the last example. That we have seen traditional consumer adoption from people opening accounts, then moving to, let's say, using cards at ATM, then probably using cards other places, then net banking, mobile banking, and things like that. But the UPI is digitizing at a very crazy space. They're bringing customer to banking through mobile itself. So your first, so you don't need to actually migrate. You actually start from there itself. And that's extremely
mobile first audience. Yeah,
because
absolutely.
this cycle got broken over last 3 years, where consumers are adopting to banking only on that, and that's very important because dealing with money online is a sensitive subject, but people are building trust. Even small vendors or everywhere people are ready to accept payment digitally.
Just picking up that thread, Neetu, if I may, and Anjani to you. I'm watching the stream of questions come in, and I'm going to work that into this. They are very much pro banking, and I think to Anurag's point, if you look at the NPS scores of foreign banks at the time that all the neobanks succeeded there versus the NPS scores of Indian banks are way better off, right? And Jitendra, this is going to come to you as well. So the stream of questions is actually quite skeptical. And saying that people like HDFC are going to win, and what can you really do about it? And I'm curious to hear your point of view of, do you see all this neobanking fad, or do you actually see from your vantage point that this is more real? And where is the innovation?
So Avnish, first of all, thank you very much, Neetu, Avnish, for having me here on this panel. We see a complementary capability coming in from the fintech world. See, banking is being made easy, and every other day using digital, it's being made so easy that even an elderly person can use it very easily sitting at the comfort of their home. And we are bringing the consumer tech experience to banking. And this thanks to a very vibrant fintech ecosystem that we have. It is being done. And it's also pushing the banks to similarly innovate to make things easier and better. So that easy banking is coming in. A lot of new thinking, innovation is coming in from this vibrant ecosystem. This ecosystem is also removing a lot of friction points. So when you take a banking product, there is KYC, there is underwriting, there is a collection, and there is a lot of innovation which is being demonstrated in each of these areas by technology companies which are very capable and building these products. So there is a lot to learn from this sector on how these things can be made better and easy. This sector is also driving a lot of speed and agility. It's not that banks are not innovating. There is a certain pace at which innovation is happening. But what fintech is bringing onto the table is, telling us that these same things can be done much faster, with much more efficiency. So they're using newer age technologies, open stack, AI, ML, public cloud adoption. All these things are happening much faster, and even banks are getting onto that. But a lot needs to be learned on that side as well. Once you build a product, how to drive adoption, that's also, a lot of, I would say, creative things are being done to drive adoption. So there is a lot to learn from, this sector, which is there. And I see a complementing capability coming in for banks from this perspective. We just need to crack that partnership model, that how are we going to work to ensure that these capabilities that India is producing is not lost because we cannot figure out a way to partner. And that partnership can happen in terms of a technology partnership. Banks have been, I would say, using a lot of technology products from large OEMs. Why not work with fintechs to create some of these similarly good products with good experience? This can be in the area of digital distribution. This can be in the area of creation of new products and services, which we've not thought through yet. So I think we just need to crack how to do this partnership. In terms of disruption, I think India is a very, very big market. We have not even touched a good part of it yet. I would say the growth over the next decade or so is going to be quite big. So there will be enough room for everyone to play. So that shouldn't be a concern for any of the companies here. In the urge to make some of these things better, the other thing that we need to keep in mind is, how do we make it regulatory more compliant also?
Yeah,
That's
I think
another
we'll
piece
come to that. I think
That
we'll
was
come to
bound to
that.
come.
Yeah. Jiten, I'll give you a chance and then turn it over to you, Neetu. There's a specific question also about what are the types of innovations neobanks have done. So maybe if you can address that as part of the broader question and specifically on deposits.
Sure. So it's a tougher question though. So I think, Avnish, if you look at it, like what exactly neobanks are doing, and I think I keep saying this very often that it's not like neobanks are solving for that if you deposit 1 lakh and it will turn into 2 lakhs next day. I think that's not the magic neobanks are doing. I think the neobank or so-called this new age digital banks layer is all about like the customer centricity. So the way you experience the product of how your money is being managed or how you are kind of automating most of the tasks. So like a simple example I'll give you. Like today, when I look at my bank statement and without naming any bank, like literally this is the tax filing season. And like I have to call my RM to find out what this transaction was for. And literally it's that complex. It like and like what the neobanks have done, and it's very simple thing, which is that like you can tag the transaction, you can categorize the transaction automatically. We don't, as a consumer, you don't have to worry about where the transaction was recorded and all of that. So I think this whole centricity around customer experience of dealing with the money, that is what neobanks are bringing to the table, and that is what I would call as so-called innovation or improvement in your banking experience. I think that's the real thing. I'll also add a perspective to what Anjani mentioned. So I think while Anjani said it's a complementary thing, and which I completely agree, but I'll add another perspective from a market size standpoint. I think I was reading a report yesterday only where it says that all private banks put together have 32% market share in deposits or the asset side. And SBI alone has 30%, and the rest is all other banks. Now, what that shows is that like even the 40% market, when we look at it, that's a large enough market, which is like bigger than all private banks put together, where I see a real opportunity, if you ask me. Like even if I give or acknowledge the good work which all these 32% share segment are doing, and they will continue to do, the 40% market is still available to be captured or to be serviced by this new age banks, and that's the opportunity I see in the real world.
Got it. On that one, I have a follow-up question, both Anurag for you and Jitendra, and especially given the Jupiter experience, right? That in general, one of the things that we find is on the asset side, you can have as much digitization, but when people are giving you money, right? And if you really think about it, truly customer trust in a market where trust is really important, and servicing, is there right now, of course, you have partnerships, but is that something that you see pan out in a fully digital setup? And what have been your learnings in terms of making that happen? Because the moment I'm giving someone my money, I would still want some sort of physical presence, etc. Do you feel, Jitendra, that's something that can potentially be done in a fully digital manner, and your experiences?
Sure. So first of all, I would admit that many of my personal myths are broken. So when I started Jupiter, I thought that a digital native customer would do everything DIY, and they don't need support, and make the product so self-service that they will never reach out to you. We did all of that, but we still see like 1 to 2% of the customers reaching out to us every month, and I think that's a massive number if you ask me. And which means you have to build your service infra, the backend, the ops, everything like very, very religiously and in a like a very operational heavy way. And that's a hard reality, which even we saw. That being said, when it comes to trust, I think I see this as an evolution. So in 2010 or 11, when Flipkart had launched, I think there was this whole thing that, okay, can I trust Flipkart or the e-commerce entity to buy things digitally or online? And I was part of the same camp. Like, can I trust these sites? And now when I look at it, my 99.5% orders are online. So only 0.5% are the physical purchases. So that's the evolution which we have gone in the last decade. I think the banking, the same thing is going to happen, where there are the two type of behavior which we are seeing. One is customers who are existing to banks, like people who are like above 35, well settled into the banking ecosystem. They open Jupiter as like a secondary account, and they start putting small amount of money first, and then over the months they start increasing the relationship with us. Like I have seen, like the from month 1 to month 10 behavior is almost like 7x increase in relationship. So of course there was a small relationship started, and that as the trust started building based on the service or the product experience or the all of that, that has started increasing. The second is the whole digital native customer, where we are getting surprised that the customers are putting Jupiter as a first account, as a salary account itself. And while that number is small still, but we have already started seeing that behavior. So after the first 3 months of interacting with us, they have started putting in their salaries, and these are the customers who are below 30, because for them this is the primary, like the first banking experience which they're seeing in their life. Like they have seen in their college life the SBIs and all of that, but now when they're sort of matured into adult and self-earning behavior, they're seeing this, okay, this is the banking experience I expect, where everything works at a click. And I think so from them, that earning trust is relatively easier, if not easy, compared to a 35 plus generation. So I think these are the two behaviors which we are seeing.
Got it.
Yeah. So quite agree to what Jiten said, but just want to add to it, like the example he gave, 40%. Also, we have to remember that there's a lot of formalization of banking happening. So the pie is increasing from existing base. I'm not even counting the growth in banking which will happen, because thanks to, as economy grows, banking will typically grows at double the rate of economic growth. So that's the thumb rule. So these are two things. But I think coming to the trust factor, thankfully, we are a credit-oriented product to begin with, so we didn't have to solve it. But there's a nuance to it. As of now, the neobanking or neocards model is all linked to banks. So there is a bank behind, and all of us make sure that that is known to the customer in the onboarding journey, and they are aware about it.
Powered by it.
It's there, so it just makes so you get a best of both worlds. You also have a bank, you also have a neobank, which is kind of giving you a better experience in the front. And bank customers have full access to whether they want to reach out to bank directly, ombudsman, all of those services, whatever the regulatory requirement is there, is available to them. Having said that, we also have seen the similar behavior that typically the important segment is 25 to 31. And that's the segment which opts for mobile financial services much more compared to others. And it's more of a engagement oriented product. People start small and then they go with you. Also, we are seeing that, like, it's true, it's happening now in banks also. A lot of people who opened private sector bank account also didn't close their public sector accounts. They just added to it. Okay. So, the same behavior is happening here. It's not that customer will be exclusive to us. They will maintain their other bank accounts or other cards as well. And, they will just keep, decide to choose depending on the experience they're getting, which one becomes the primary. But
Got
I
it.
think it'll be an either or scenario, in the Indian context. And we have seen in the e-commerce space also, how many people, when they're looking for Uber and Ola both, when they want to book it or they want to check out price at both the places. This is how the Indian consumers' behavior is. They are by design much more discerning in nature. So this will play out in banking as well.
I think maybe one additional thing here, because here the banks themselves are also disrupting, right? So you have an SBI, you have a Bob World, you have various banks coming up with their own challenger banks. Any perspectives, and Anjani, particularly from you, in terms of how that, are we going to give the neobanks a run for their money, or like how is this going to play out?
Of course, see, to meet our customers, demand, we have to innovate. It's not that we can just continue to serve the customers in the same old manner. So we will bring out our own innovations, and this could be in form of different products and services, what you're seeing with some of the banks. And that's a very good way to challenge our legacy also. So if we have built something which is really good, scaling up, can we bring in a transformation through using digital technologies and make it grow much faster, improve customer satisfaction, improve the cost to income ratio of the bank? There are so many possibilities by doing these things. And it's imperative that we take that initiatives ourselves and try and disrupt in these areas. Otherwise, market is not going to stay the same way. So we are definitely proactively taking a lot of measure, and that you are seeing across the banks. Almost all the banks are bringing out newer capabilities in digital space, both by themselves and by partnering with some of the capable fintechs that are there in the market.
Neetu, I just want to add one more point before we move on from this section. So banking is a service industry. So many of the time when we compare with other industries, we somehow look for much more tangible economical benefits. And in our industries, experience is superb. It's like one of the most important factors. Let me give you an example. If you look at top 5 private sector banks, is there any difference between the services? I'm like, rate, there was a difference, but at least for one bank having a higher rate. That also got shifted. Now it's almost equal. Even if that bank had a higher rate, the deposit didn't move from other banks to that bank. So I think we sometimes underestimate the power of experience when we compare to other industries where they are much more tangible economic benefit. For example, buying a laptop, what you're looking for, can I get lower into that? But banking is much more deeper. It's much more experience oriented. So I think that's something that's a connotation we have to remember. Like, for example, like, does 20% off on a particular brand matters? It does matter. But if I give that, will everyone shift to me? No, it's not going to happen like that, which is not the case. If you want to sell a mobile phone at a particular shop at 20% off, probably everybody will go and shop there. So I'm just saying that's a nuance about, money business, because the experience, even trust gets built over experience only. And
I'm trying to remember my marketing 101. I think it was called Credence Good or something, but we'll check that out. So maybe now,
Neetu, as we move from this, just summarizing the trail of questions, I think just for this section, at least what I have heard, because there was a lot of skepticism. We have somebody from banking here who's saying they see synergy. The fact that the industry moves faster is beneficial for all the customers and the skeptics. Tech, but most importantly, to Anurag and Jitendra's point, and I think Anjani's also made this point, the customer centricity. And I think overall, everywhere else in the economy, we don't question it when we see people aspiring for better and better. The reality is they're aspiring, the number one thing they should aspire for better, I think Anurag put it well, is in financial services. So I think that in itself is the raison d'etre that is going to push the whole sector ahead.
Yeah. And as you think about, within the sector as well, right? Two of the points that we alluded to in the slides, which is now coming into the sustainability of the entire cost of acquisition as well as, the ARPU. And I know, Jitendra, you work quite a bit, on the CAC side and, how to make that sustainable. Any learnings from that you have seen?
Yeah. So I would say that, and I'll give you like few real numbers just for the context. So when we started, our CAC used to be around 1,000 to 1,200 bucks per customer account open and a funded account open. Now our CACs are anywhere like 500 to 600 bucks, and I think that's the optimization or the efficiency which you achieved. But also there's also a factor of trust, I would say, that once the customer has seen that okay, this product works, or this product there are fair amount of adoption happening, generally there is a word of mouth, generally there is a sort of a organic way of customers coming in. So like our organic rates today are almost like 47-48%, where we don't incur any CAC. So I think that is the way it sort of leads to with the scale coming in. So I think that's the summary. I would say that still early days, but with the new scale which we see in coming years to come, I think the CAC will remain optimized. And thankfully now with the funding winter now, we see CAC further getting optimized, at least in the near term. So I think that's going to happen as well.
That's an interesting one. And, since partnership came in, even in a couple of questions in the chat and at broader level, right? So if I see incumbents which have, a treasure trove of, customers and customer data, and you have, CAC being a challenge in many of the neobanks, is there an opportunity, since Anjani, you also talked about partnership earlier, here to, make some of that happen?
Yes, when we actually look at reducing friction from the customer journey for acquisition, the productivity definitely goes up. There is a segment of customer who are coming on their own without being assisted by bank officials. And then there is another segment where bank officials have to help, but their productivity goes up because the journey is much more simpler and easier. So it definitely has an impact on CAC. If the experience is good, customers are easily able to go through it on their own or in an assisted manner, the productivity goes up and it will have an impact on CAC. It's just a question of getting that scale where you can see a material impact coming through. So that part is definitely there. And in order to do this, this is where the partnership will come in very handy, because a lot of these innovations which are happening, if those can be brought into the acquisition cycle. See, essentially banking is about onboarding a customer, offering different ways to transact, and then you do your servicing or life cycle management. This is a pretty simple business actually. So if we can ensure that onboarding is easier, transactions, a lot of work has happened, based on, you can see UPI, how easy it is to transact. The whole experience has been standardized. And no matter which bank you hold an account in, and which property you go to, almost a money transfer experience is very similar. It's not very different. So it's been made so simple. So transaction is easy, but we have a lot of work to be done on onboarding, which is a process which has got a lot of friction points like KYC. Their video KYC and the liberalization which is happening through recent regulatory measures is helping, but still it's a little complex process compared to transaction. And on the servicing side also, a lot of innovation is happening, but we have a long way to go, because that is what defines actually banking relationship. How many, if a bank customer wants to meet their relationship manager, can they reach out at any point of time? If they want a help, I've lost my card, I want to reissue it again, can I do it 24/7 immediately without calling anyone? So all that comes into the customer life cycle management. And there also a lot of work has to be done on servicing a customer. And if we can solve these two areas, then it'll be a lot more bigger pleasure to bank in future.
Yeah, I fully agree. But the challenges that you brought, for instance, on UPI, right? If I now start to talk on the ARPU side, on monetization, because so many things are, already where, there are already constraints on monetization. And so maybe Anurag and Jitendra, from you, how do you think on the ARPU side, things would play out? And, are there line of sight that, these are the ways we can already start to see significant monetization happening?
Yeah. So banking is by design a long-term business. So, and if you don't, stay in long-term, you will not make the ARPU which the banking has been built on. So that is the first principle. So you definitely have to have the sustainability horizon in your mind. So there is no question asked about. Secondly, if you're dealing with bank will also need to ask you the same question, that will you survive? Because you're managing, experience on our behalf. And if you are bank yourself, then anyway, the regulator will ask you the same question, that how will you survive to, sustain that? So I think this is a, no-brainer. Having said that, coming to monetization side, now, banking is also a very high OpEx business. And that's where a lot of us are solving to reduce costs by using tech. And in my opinion, that is one of the biggest source of, competitive advantage, which all fintechs have to think through, which is, CAC is one. CAC is a, you deal in markets and, it will go up and down depending on how the market dynamics change. The good thing is there is a large opportunity, and, you've got to figure out your product market fit so that your CAC is in the acceptable zone. Having said that, I think the bigger opportunity is about cost of operations, cost of servicing a customer, because using tech, you can actually create a very large gap there. And, which is one thing. The second part is, and if you are able to engage with the customer, make yourself the primary relationship, then you also consolidate the ARPU across, which is distributed. That's one part of it. Second thing is, of course, I think third thing is, probably I'm a little biased towards it because I'm asset side company. I'm like, the monetization in banking gets built through assets only. So people who have not built assets have to think for assets. Because that is where the entire banking industry makes money, by the way. Of course, there are opportunities to build third-party products, investments, insurance. That's also a big source of revenue. But assets side is much more, readily available. And given the gap in credit, which is there in the market, I would strongly, recommend and advise people to think around those things. Which how can you build a, credit side? Monetization play, but just want to qualify that, because a lot of time I hear this, lending is a high margin business. Just want to make it a point, lending is not a high margin business. It's a low margin business. If you don't get the last EMI, you basically make the profits to loss. The second thing is, lending is very difficult to build engagement in lending, because consumer behavior is to look for best deal every time they borrow. It's a need-based product. So you've got to really work hard to build engagement layer. The only good news is, and I agree with you, Neetu, that existing banks have large customer segment, a large customer bases, relationships, and more importantly, data. But there we are seeing a lot of work happening. So bureaus are available where you can get access to data if the consumer consent is there. We're also awaiting account aggregator, which the way it has been designed, is going to will allow consumers to move data wherever they want to. So I think net, if you're able to crack engagement, trust, consent, you're in a good shape. Rest is easy. But if you don't crack that, all of this CAC ARPU will not make sense.
Got it.
No, so I guess just picking up that thread, Neetu, for Jiten. So, and there's again a stream of questions around this whole lending. Is lending the only source of monetization? So is getting a hook in and then monetize with lending, and how are you better placed to lend?
I'll tell you, Avnish, there is, before, in India, most of the banks, like in the global markets, fee income is a very strong source of revenue, especially advisories, and people don't mind paying fees. But in India, we don't like fees. I mean, even banks charge ATM withdrawal fees or account maintenance fees. It's a front page newspaper article, even for banks like, SBI, large public sector bank, governed by government, people. So we just don't like fees.
We don't like fees upfront. We may pay in the mutual funds commission, which we often don't even realize.
We just don't like upfront. So, that's why majority of the banking businesses gets done through NI, even if the fee incomes of the banks are linked to lending. A lot of this is linked to lending on transactions which are otherwise doing. So I think some of this, like for example, a lot of European neobanks, the biggest model is what you call interchange and forex conversion. Now that's not big in India because unfortunately we don't have such friendly neighbors where people just keep going up and down. Very few number of people who go abroad. And interchange post UPI is almost zero on deposits. So it's like a very different market. So that's why the context of this becomes even more important. We got to really figure out our Indian model. We can't learn from outside. Yeah. Sorry, Avnish, I cut you off. Yeah.
No, I was just asking Jiten also. Anything to add, Jiten?
So yeah, so I would just summarize it rather that I mean, if you're getting into the banking business, like you have no choice but to do both the deposits and assets, and because that's the core, right? What is the banking revenue? The banking revenue is about NIM, which is the difference of interest between what you give and what you charge. So from that standpoint, I think by nature of this business, you have to do assets, you have to do liabilities, and that's how you make money. Like I don't know a single bank anywhere in the world which sort of says I will take only deposits and not do lending, or I will do only lending and not take deposits. Because even if you do only lending, your deposit, your lending cost of capital is a very important lever to make money in the lending business. So which comes through the deposits and vice versa, right? So if you're just taking deposits, you can never make more money, or I would say you can never be profitable if you're not lending out that money to make more money on that. So I think by nature of this business, I would say you have to sort of do both sides, not just one side. That's the reality.
Got it. Got it. Maybe I'm going to move, towards the last section on regulation, right? Because while we've been debating all of this, the elephant in the room is this is still a bit of a, vacuum that we are working in. So, there's a lot of regulatory open space as we think about neobanking, and many countries have clear frameworks, and for us, of course, Niti Aayog came up with some of the recommendations. There's been talk that something within RBI might also come at some point of time. What are your views in terms of what kind of elements of clarity, if someone from the regulator was listening, what would be your type of wish list on what type of clarity should be there within this framework?
Then you want to go first?
So yeah, let me take. Okay, Anjani is saying okay. I can take a shot. So I think I would say that like what is ideal, right? And from a regulator standpoint and from an industry standpoint, I think from a regulator standpoint, the ideal thing is, okay, if these are the entities wanting to get into the business, do they understand the business well? Can they make the business work at a P&L level, not just at a product level? I think that is the crux of the whole consideration set. And I think the entities which can show that they can make, or the founders or the promoters who can show that they can make the business work at a P&L level, they would be looked favorably and maybe considered for any kind of regulatory regime. But from an industry standpoint, yes, the ideal is to get into the regulatory regime and without having, and I'm talking about the ideal world first, and then I will talk like what is not so ideal world, but but kind of a balanced world. So the ideal world is without any shackles of having PSL obligations, without any shackles of having the 1,000 crore net worth capital and all of those kind of things, right? That's what every industry player would expect. But I think the balanced view is that if you're into this business, this is a serious business. This requires capital. This is a trust-based business. So you need to show stability to the customers and to the regulator. So from that standpoint, I think there has to be a high capital bar for sure. That's what I believe in. There has to be the banking is all about societal obligation. So there has to be obligation to society. I think you cannot shy away from saying that I don't want to service a particular segment of customers. I think you have obligation. If it's all said and done, it's looked in India at least as a public services business. So from that standpoint, you have that obligation to fulfill. So any founder promoter has to have that mindset about meeting that obligation. And the third thing is managing the business in a self-sustained manner rather than continuous need to raise equity capital to sustain. I think these are the three broad contours I would look at if a founder or promoter has or is expecting to get into a regulatory regime. That's the way I look at it.
Yeah, so I'll just probably add some context to it that if you're dealing with money, regulations are going to be there. It is, and since banking being a core sector, it affects everything. So, like the RBI has an obligation to ensure that the sector runs healthy, because when the bank goes down, it doesn't go down alone. It affects the entire sector, other sectors, borrowers, segments. And, so I think regulations are there to say, and many a time when I come on these, sessions and people ask that, like we're a tech company, how do we're supposed to know regulations? So my simple answer is, if you want to be in financial services, you have to know regulations. It's as simple as that. It's like if you're coding, you got to learn languages. That's why if you want to be in financial services, you have to know regulations. There is no two ways about it. The second thing is, if you become a large entity, which most of us would envisage ourselves to, there is no choice but to be regulated. And the two other areas to mention is that in India, financial education is still quite low. We don't teach them to our kids as much as we should have. Money is not a subject people love to discuss. We have a little dysfunctional relationship with that. If people talk about money, we don't see it appropriately in social forums. So hence, financial education is quite low. The second thing is, we are a very sensitive country in terms of, KYC AML perspective, because we have, money flow happening in many other areas. We are a large country. We have 1.5 billion people. So all of this makes the regulation even more complex. So not only regulator is supposed to regulate, but they also have to think of consumer protection, because the financial awareness is quite low. So I think that's the context we have to look at. We don't need to look at as these are the guardrails. You got to live with this if you want to build, in this segment. So that's going to be there. Now coming to, I think, Jiten has already mentioned all the wish list. We would love to see in what context it come in. The good thing is regulator has been bringing up lots of clarity in the regulations, especially in last 6 months. We have seen lots of regulations coming in different areas. The most promising one is setting up a fintech department. Now, many of people don't know on this forum that 2005 is when DPSs got set up. Before that, there was no separate department for that. And we have seen a massive growth in payments after that. 2006, when the customer service department got formed and when the banking ombudsman scheme got launched, and we have seen a lot of protection happening after that. So this is the precursor for it. In short term, there might be some upheavals because naturally the models have to get aligned to what regulator says. But in long term, it will be good for founders and investors both, because both of us get the clarity around which we have to build businesses. Because the underlying opportunity is not gone away. I'm like, is there a penetration problem in banking? Yes. Is there a people looking for digital services? Yes. So I think that's something we have to keep in mind while going through this short term. If you ask me, it's good that the clarity is emerging from regulators so that we all know what and around which we have to build things on. The last master circular came on outsourcing was a very promising one, where although it's a draft one, they've also mentioned that they will come up with a cybersecurity framework, which is also extremely contextual for all of us, so that the guardrails are very well defined. In fact, they're also figuring out how to define fintech. Fintech could be, say, banks, regulated entities, there is a regulation process, there is a licensing process. So naturally, they also have to define, okay, within tech industry, who will operate where. So all of those thinking is being developed. And as we go along, I think this will more, I'm all in for regulations. It just becomes much more clearer for all of us to know where to operate.
What about you, Anjani? I think there's always this talk that, if there are banks which are going to come, which will have no PSL requirement or no branch requirements, what happens to the incumbents who have to, follow all of it?
See, from our perspective, Neetu, we would expect that if there is a structural change, that there are banks coming with no PSL requirement or no branch banking requirement, then there will be a level field, and even banks will be allowed to have a division which can do the same. But one thing that I mentioned in the beginning, that we are bringing consumer tech experience to all our products, making it very simple. In the process, we are also pushing the boundaries of regulation here. And at several places, to simplify KYC, we simplify so much that there are errors which are creeping in. With digital going in a big way, we are also seeing frauds happening in a big way. And when money moves from a banking system, it requires another container, which has been, lackadaisically opened with less controls from where the money moves out. So we have to be sure that whatever is the KYC, AML, regulations that are being put, it is equally applied to all the partners and all the players in the ecosystem, including things like, customer complaints which are monitored, or how you collect when you are lending. All those things should be very similar. If it's not the same, then if you are participating in a financial ecosystem, then you become a weak link from where things can start leaking out. So that should be avoided. And if that is done, a lot of banks will be able to participate in this process a lot more in a better manner and a faster manner. We've heard of very few smart programmers getting together and creating a digital experience, which is a world beater. They just go on to Amazon cloud, take a few CPUs, start, deploy a program, and they are now collecting money, dispersing, making payments, everything. Banks cannot do that actually. That's very, very difficult, because you cannot go into a public cloud and keep data over there, which could be taken out. We have to put our own encryption key. We have to put our own landing zone. These things are difficult. I mean, it's not so easy to do it on a public cloud, but banks will have to follow that process. Likewise, when it comes to adoption, there is a different way of pushing these products also. When a fintech or a neobank goes to a small SME and sells a bank account, they don't sell a bank account. They say that this is how you will manage your business. This is how you will make payments to your employees. This is how you can do your reconciliation of books. This is how you can collect money from your customers. So they are selling a holistic solution for that company. And a lot of these solutions are actually outside the ambit of banking regulation. Banks cannot provide these because these are non-banking solutions, but these are important. These are peripherals which are needed to be packaged as a solution. Nobody wants to take a bank account. They want to do certain things with it. So all we are seeking is that if new banks or a regulator is thinking about bringing in new innovations here, even the incumbent bank should be allowed to do business in the same manner, so that we have an equal footing and we are able to bring the benefits of all this together for the citizens of this country.
So Anjani, I think it's a great point, and it was a great insight from you yesterday, both on the solution orientation and again the general chatter. The view would have been, looking at all these regulations coming out or restrictions coming out, that wow, banks are now really favorably positioned. So banks should be laughing all their way to the bank, and the fintechs have issues. And what I learned from you yesterday, which I think is worth reiterating, that you are also desiring as a bank, as long as it's a level playing field, more regulation, because that will help in getting closer to the going back to the customer centricity point in terms of solution orientation. Banks also need this regulation to develop further, which will help both banks and fintechs.
Yes, absolutely. These new guidelines will help the entire industry. package the product in a more customer-centric manner and bring it out.
Yeah, on that note, I think we are reaching just about the end of the hour. I think a very insightful discussion. I think right from innovation, where we looked at, actually a lot of innovations happening both at the neobanks and even within the banks, and, different areas, whether it's customer adoption, engagement, and, lot of insights on that part. And the interesting part being there is enough for both. It's not like, with the country like India, there's enough room to grow for, both such areas. I think on the sustainability, both CAC and ARPU were interesting discussions. Looks like with the funding winter and a lot of things that we are doing, we may have some handle on CAC and ARPU. Again, we are looking at various different, elements of monetization. So it's almost like a jigsaw, coming together. And finally, on regulation, I think it was interesting that almost everyone wants more clarity that is, even if we are supposed to or not supposed to, it's better to know, in advance. I think that's great. And as much as there's a level playing field, I think that's seems a fair ask from, from the various elements. So looks like both, good things to learn from both sides, and looking forward to see how this plays out.
Thank you. Thank you, Neetu, and thank you to all the panelists. I'll leave people with a closing thought, which is, the fintech industry has been in the front pages of the newspapers every day. Somehow we managed to time this very beautifully. And there's regulation. And I was reading somewhere that the bottom of a bear market is generally indicated when you are on the front pages of the newspapers and front and center for the regulators. So hopefully going forward, it's all up and to the right, but in a balanced way. This is an industry that I think needs to work in synergy between innovation, sustenance, and regulation, because there is an existing regulator, and not try to ignore it. But again, thank you to the 200 attendees who came. Thank you, Neetu, for moderating, Jitendra for getting up early, Anurag, Anjani. Really appreciate all the insights.
Thank you, Avnish. Thanks, everyone.
Thank you so much, Avnish, Neetu, Anurag, Jitendra. Thanks so much. We've enjoyed the conversation.
Thanks, guys.
Great. Thank you. Bye.
Bye.